And we are live. Dun, 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 dun. This is Ask Me Anything About Investing, Personal Finances, etc. So let's get right into it. The free giveaway this month is the 2020 Buy and Hold Analyzer for rental properties. If you ever wanted to run your own properties, well, you don't need to have any money here. You can just download it for free. It's in Excel or Google Sheet. I prefer Google Sheet format. Full explanation of all expenses for you to make your own pro forma and run your own deals, and spot check your own the pro forma that's given to you, and ability to perform sensitivity analysis. You can get this by texting the word simple to 314-665-1767 or emailing me at simplepassivecashflow.com. You guys haven't checked out my podcast, go to Simple Passive Cashflow, found on YouTube, iTunes, Google Play, iHeartRadio, and check out our online community. If you want to submit a question, which some of these questions I got from today, let's go to simplepassivecashflow.com/question. All right, first one here. I'm reading these up a lot for the first time, just to keep things interesting for myself. And the first one is, what cash on cash return would you recommend for a single family home rental property where the goal is cash flow, not appreciation? So normally, I think at least an 8% return is what you're trying to shoot for. So if you're using an analyzer, what I would put in there, and make sure you're also including all the repairs, maintenance. Most people forget about the CapEx and the vacancy that you're going to have, and also include the property management. So for a property that is, rents for $1,000, for some of you guys can buy $100,000 houses out there that will rent for $1,000. If you live in Hawaii or California, you probably think that's crazy, but that's how most of America is, and that's what the kind of the houses that we buy. Excuse me. So out of $1,000 rent, each of my fingers is $100. You're going to put aside $100 for repairs, $100 for big CapEx items. And that is, you're going to eventually need to repair the roof, maybe paint the house, big items, big items. That's CapEx. And you're going to need to spend another $100 or so of, just stuff is going to go wrong, right? Things aren't going to go the way you want it. So you want to have that money sitting aside, and you're going to have vacancy. Another $100 is going to be paying your professional property manager, because we teach you guys to be investors, not landlords. You guys shouldn't be going over there and fixing up stuff at the house. That's the old school way. That's fine if you only want to pick up 1 or 2 rental properties, but that's never going to get you financially free. And then the remaining money, the rest 6 fingers here, maybe $400 is going to your mortgage, insurance, and taxes, and that leaves you $200 right there. And 2 out of that much is $200 is pretty good buffer, in my opinion, that you should shoot for, assuming that you're accounting for all the expenses in your underwriting. But again, download the analyzer and run the numbers yourself. And after it's all said and done, on that $100,000 property, you probably put down $20,000 or $25,000, and you're making, your cash flow is that $200 a month. So 2 times 12 months a year, that is $2,400 a year. So I think the math is $2,400 divided by $25,000, right around 10%. And that's how we back into that, at least an 8% cash flow number, assuming, again, you're underwriting your deal the right way. I am curious on your positions now, given the uncertainty of future economic conditions. I am feeling like know when to hold them is a smart idea for a few months. What are your thoughts? So I used to think this back in 2012, and then 2015, and then 2016, and then 2018 and 19. As I was buying properties that cash flowed, as we said on the last slide, you only buy properties that are positive cash flow and can pay professionals to run it for you. If you don't have enough money for vacancy, repairs, CapEx, professional property managers, and the occasional oops, you shouldn't have bought the property. You're not cash flow positive in the true sense of the word. Just because you're you're renting a property out for $2,000 and your mortgage is $1,500 doesn't mean you're cash flowing 500 bucks. That is absolutely wrong. In fact, that in that kind of situation, you're probably negative cash flow when you're accounting for real repairs, expenses, maintenance, capex, vacancy, and property management. So if the way I see it, like most people don't invest like this, right? They don't invest for cash flow, which dumbfounds me. But when you're investing for cash flow, I mean, I don't see any reason why the economy is going up and down. I mean, you're just kind of dollar cost averaging. You're just picking up more and more assets that make money on a monthly basis. And you know, most cash flow investors are pretty immune to the economy. And after going through a pandemic and seeing my collections pretty much across 3,500 units stay above 90%, where break-even point is in the low 50s and 60s, I mean, I'm pretty confident that this workforce housing investing for cash flow is the way to do it. A lot better than investing in something silly like Airbnb, short-term rentals, or something like commercial storefronts where the restaurants go out of business. I think we've seen the strength of workforce housing. People need a place to live. If I invested in those type of stuff, or especially like equity markets and stocks, yeah, I'd be so scared right now, of course, especially stocks, right? Because it's all fake money, right? How is it that you have all this high level of unemployment, yet the stocks have kind of retraced right back to it is? Well, I mean, if you watch like what a lot of people like Richard Duncan, their commentary on the economy, you know, it's all fake money that's pumped into the system. I mean, they just allocated what, $3 trillion of stimulus just in the last few months with the CARES Act. And then I mean, there's pretty much 3 or 4 rounds of stimulus coming. So yeah, I think most people are really scared right now, but if you're investing prudently with cash flow, I mean, just continue to just evaluate deals that cash flow. I think you're fine. And like I said, in the beginning when I was doing this cash flow investing, I kind of thought the same way, but you know, as the years have rolled by and you see little dips in the economy and how you're unfazed and you know your tenants still pay your rents, that's what keeps this thing going for cash flow investors. But yeah, most investors, you know, they watch the news. That'd be another suggestion of mine, is don't watch the mainstream media, because it's just a bunch of fear mongering, and they're just kind of, you know, they're selling attention. They want you to watch the news, so they're going to try and freak you out. And unfortunately, you know, your lay investor out there is watching that stuff, and they're afraid. And when people are afraid, they don't do anything. They kind of hold them. But you know, some of the groups that I'm around, you know, very, very high level accredited investors have seen a bunch of these black swan events, is what they call them, before, and they say, you know, this is textbook white black swan event. This is the time to move in and swoop in while everybody's sitting around scared under their blanket. So definitely 2 paradigms out there. You got to decide which one you are around. And if everybody around you is saying one thing, that they're scared or not doing anything, or what's worse, saying they're going to go back into the stock market, maybe it's a peer group thing, right? Next question. It seems like everyone is talking about the market being at peak right now. And personally, I think things rings true for multifamily, even more so than other asset classes, given the situation. How do you personally decide how much to invest in opportunities today versus staying liquid to invest potentially greater opportunities in 1 or 2 years? It's a very similar question, but a little twist to the last one. My investment philosophy is just always be investing when I have liquidity, I'm going to invest it. Again, some of the rules that I follow is I don't invest more than 5 or 10% of my net worth into any one thing, to get diversification that way. And I'm spreading around my portfolio in 2 big ways. The first way is different geographic areas. And then the second is different asset classes. I mean, most of my holdings are in apartment complexes and, you know, some mobile home parks, but no, I haven't really branched out too much into self-storage or some different asset classes. I definitely have, you know, done a bunch of development and getting more into that. but diversifying into different opportunities is a good way of, I think, for anybody, and that's what I'm doing by myself. Um, as far as A, B, and C class properties, I think I'm kind of moving on from Class C. And Class C, I think everybody gets a little woo-eyed over, you can get 10+% cash flows, but it's a hard clientele. Like the Class C tenants, they're hard because they don't have too much cash savings, and collections is very difficult for that type. And often, you're trading a lot of sweat equity, especially as an operator, of course, for that. But even as an LP investor investing in C-class deals, cash flow is very hit and miss. I'd say it's kind of a coin flip if you're going to see cash flow on that thing. As the asset gets stabilized, it's going to take a long time to get that asset stabilized for Class C. So one way I balance staying liquid, I use infinite banking. So if you guys want to learn more about that, go to simplepassivecashflow.com/banking. But it's a technique that a lot of wealthy families will do to use life insurance as a means to not pay taxes, because it's a little tax loophole. You don't pay taxes on life insurance. And when it is life insurance, it is very hard to get sued for that money. So it's litigation friendly, and it's a way where you can make a nice little yield tax-free. And people like to use that as their sort of dry powder fund. And I do a little bit of that, but I think you hear like Warren Buffett, I think people will ask him, well, how much cash is in the Berkshire Hathaway funds? I forgot how much he said, but it was a larger chunk than I thought. I mean, me personally, I'm kind of about maybe 10-20% liquid. I think a lot of newer investors have this attitude where they justify themselves not doing anything because they have this mindset that, oh, when the world comes to an end and then it doesn't, and then it doesn't, and it doesn't, well, then they'll have all this money to swoop in. But the truth is, you never know when the world is going to end, if it's going to end. And if you're not playing in the game, you won't have access to the deal flow, the lenders, and you won't even know. Part of this whole thing is learning. If you're not learning, you won't even know a good deal if it hits you in the forehead when the so-called world ends anyway. And again, I just think it's some kind of subconscious means and an excuse not to do anything. Because I've seen this happen from like 2009, 2012, 2015, 2007. I saw people just waiting on the sidelines, and I see them 8 years, 5 years, 3 years later, and they still haven't done jack. So, keep investing for cash flow, and, put a little bit of liquidity on the side is what I say. Is real estate investing worthwhile while I may be on island for only 3 years? So I think this came from an investor who was looking to move to Hawaii, a beautiful place to live. But I am definitely in the camp a lot with other cash flow investors where we live where we want, but we invest where the numbers make sense. And that is not Hawaii. Hawaii is one of the worst rent-to-value locations in the country. I believe it's mostly because of the international folks coming over from Asia, just buying things cash. I mean, quite frankly, they're just looking to launder their money here and get it out of the country. And Hawaii is a very geographically convenient place for them. So if you're looking to look for cash flow here, you're not going to find it. And there's a lot of families with a lot of money that are just looking to kind of park cash in something that's convenient and comfortable to them. So, and I don't call that the smart money. I call it the opposite, and I don't follow dumb money because it's a race to the bottom. So that's another reason why I don't invest in Hawaii. So someone said, well, I'm probably sure they had like a VA loan because not a lot of people move to Hawaii unless they're independently rich or on military orders. So I'm sure they were looking to use their VA, and that's cool. VAs are nice because you don't have to put anything down, but look, run the numbers yourself. If you would have bought, a few rental properties on the mainland, how would the cash flow and how would your net worth grow in comparison if you would have bought that property to live with, even if you got a primary owner occupied loan on a zero down property. I have never ran the numbers, but just my feeling that I think the 3 or 4 properties on the mainland with the same amount of down payment might do better in the long run. And but appreciation is powerful, right? I mean, Hawaii could continue to appreciate. Not gonna disagree with that, but when it doesn't, yeah, you get pounded. And I'm just not in a place from an investor standpoint where I'm looking to take chances these days. I don't really need to. So that's why I invest off for cash flow and not for appreciation. Did this investor want to know, should they borrow or invest? I spelled it wrong, but I spell everything wrong, I guess. So I shouldn't say anything. So they're looking at a Heloc and a Heloc at 5.5 and a 50,000 loan out of their 401k for 4.5%. So I guess first thing, I mean, awesome, cool. You're looking to borrow. Most people would think this is a total sin by taking money away from your equity of your house, or worse, your retirement system, because we're all trained and programmed that is absolutely very naughty to do. You shouldn't do that. But yeah, I mean, I think you're looking at this the right way, right? Like, let's look at this arbitrarily. We are going to take a loan, and let's compare interest rates. So 5.5% on the Heloc, 4.5% on the 401k loan. From a tax perspective, if you play your cards right, you should still be able to finagle to get that Heloc as a deduction, because you are using it to further improve your business. And that's the key word right there. So 5.5, you should be able to deduct that. Might be less than 5% after it's all said and done, after taxes. The 401k loan is at 4.5%, but I don't think you can deduct that. And that one, you're kind of paying it back to yourself in a way. I don't know. I mean, it depends what you want. I mean, I think you're splitting hairs here, and you're kind of wasting your time. Hopefully, you're not sitting on this for more than a couple days thinking about this. Like, just do one. Like, it basically comes down to which one would you rather put leverage on, your home you live in or your retirement funds. To me, I think that you can look at it from this perspective. Which one of these assets is more at risk for you losing your money overnight? And I think it's the 401k than the value of your home. So I would go after the 401k loan first and exhaust that funds. Of course, to buy assets, right? Not saying you need to buy rental property, but buy something that produces income for you and makes more money than the 5.5 from 4.5% here. And that is the key, right? It doesn't matter what you're paying as long as you can make more of it. A lot of people, they ask, a very common question is, should I pay off my student loans? And the interest rate on that might be a little higher, maybe 6 or 7%. But I mean, if you look at how much money you make with rental real estate, I mean, you can go to my website at simplepassivecashflow.com/returns, and you can see my whiteboard exercise of how much money you're able to make. And it's like 20-30%. I mean, compare that to 4-5% here, or like a 6 or 7% student loan. It's a no-brainer. But we are conditioned by, I don't know who's kind of conditioning, some guy behind the curtain, a Wizard of Oz, pulling all these strings, where we think, or but I think a lot of our parents teach us, like, you need to pay off your student loans first, and that's not the case. Of course, pay the minimums, right? But essentially, this is an exercise in debt arbitrage. If you're going to make 10% in some venture that is relatively low risk, and then you go after that and you arbitrage the difference. Of course, I've got a caveat saying that, of course, this whole segment and it's just a bunch of infotainment here, because there are dummies out there. And the dummy warning is, like, if somebody's going to give you something that's not very stable, like a Bitcoin investment where they say you can make 30%, don't do that. That just sounds super slimy to me. But I gotta say it because people will do that, right? They'll say, well, Lane said as long as interest rate on that is higher, I should do it. But use your brain, guys, right? I mean, that's why we educate people to make the right decision. And there are risks in investing in real estate, right? It's nice that we have the tax benefits and it's real hard assets that the value doesn't really decay over time, but there's still risk. So it's important to educate yourself, and everybody needs to do that before kind of taking the step to writing a check. But I think a part of it is just kind of surrounding yourself with the right network and educating yourself. So I think I have time for one last question here. How can I continue getting bank loans for my buy and hold properties? The banks will not count rental income until its full 2 years of tax returns, which is almost 3 years of ownership. If I keep buying 5 units per year, my debt to income will be too high to qualify very soon. I have good W-2 income and earn a good amount of cash flow, but the bank sees me as having less and less income every time I buy a new unit until it seasons, even though the reality is I'm increasing my income. So how should I start with this? So, if your net worth is over $500,000, I think you should probably look to investing in more scalable investments where you don't have to do anything. You don't even have to put any debt in your name. Private placements and syndications. You can get more information at that on my ultimate guide at simplepassivecashflow.com/syndications. But to summarize here, this is kind of a moot point. And I'll just say from my experience, I had 11 rental properties and I had 1 or 2 evictions a year. And some kind of big issue that came up, like a leak in the basement or a tree fell on my house, maybe 4 times a year with that many rental properties. And normally I'd cash flow $200 or $300 a month on each of those rentals. So we're talking about $2,500, $3,500 of cash flow a year. Not bad, right? I mean, I'm not complaining, but let's face it, a lot of us, $2,000 or $3,000 a year is not enough for you to quit your day job or be financially free. You're going to need to triple that number. So if you're going to triple that amount of rentals and you get up to 20 or 30 of those things, now you're talking about an eviction every other month and some kind of big catastrophe that happens every other week, pretty much. And you're starting to realize how this is becoming quickly not scalable. And I didn't realize this until it was too late. So until I had 11 rentals, and it took me a long time to sell these rentals off and become more of a passive investor. But I think a lot of people just don't realize it until they do it. And these are the questions that they ask. How come the bank doesn't give me more loans? Well, the banks will give you, if you're trying to qualify for Fannie Mae and Freddie Mac debt, they should give you 10 in your name and 10 in your spouse's name. If they don't, you probably need to use a different lender, and I can give you a referral to one of those guys. But, I thought that was, when I was starting out, I thought that was really cool, right? A lot of us thought that was really cool. We're going to fanny out, right? We're cool. We have 10 in our name, 10 in our spouse's name. But now I'm in these groups of these more accredited investors, and yeah, they don't say it's stupid because we all thought it, right? We all thought that getting 10 in our name, 10 in our spouse's name was really cool, but we just laugh at it because it's like, what were we thinking? We didn't know. We didn't know any better. So I think if you're asking these kind of questions, it's probably time to take a look at your net worth. If it's over $500,000, certainly over $1 million and you're accredited, I mean, I would say, probably get out of single family home or, rental property ownership, get out of direct ownership at that point, unless you love it or you're really good at it. Most people, who are working a white collar job, their highest and best use is at their day job, not managing property managers. But yeah, I mean, there's a graph I have on my guide at simplepassivecashflow.com/syndication to kind of, if you want to line up where your net worth is and see if it's time for you to make the jump. But I think that is all the time we have for today. If you guys want to submit a question for next time, go to simplepassivecashflow.com/question and make sure you guys download the 2020 buy and hold rental analyzer. And here's the legal disclaimer. And thanks for watching. And tell your friends and check out the podcast, Simple Passive Cash Flow.